This is how premiums work. I mean, we had a couple clients that bought a few $1 million worth of them, and when we go out to buy more, we sell them at a price that that you can't really find them for, and then we go out and try to buy more. You can't replace them. So those that are, it's kind of like it's kind of like Judy Shelton's idea of pegging gold to the Treasury. There's always going to be demand for the long end of the Treasury at a certain rate, but that certain rate can blow up the entire system if it goes too high. So it's the same thing here, I mean, that was kind of a stupid analogy, but I'm getting to the point where that, you'll always be able to find these coins if you're willing to pay a certain price. And to go out and buy a whole bunch more, the premium is already up about what we say about 50, 60 bucks, about right? 50 or 60 bucks an ounce, which made it really good deal for trading a bar or a coin for it. Now it's not as good of a deal, but it still makes it a hell of a deal in buying them in comparison to gold bullion coins. So margin debt is the total amount of money that an investor would borrow from their brokerage to buy stocks. So if you put in 10,000 of your own money, you can borrow another 10,000 from your broker, and now you control 20,000 worth of stock. But half of that is debt, and there's a certain level where if it goes below that, you have to come up with a margin call to keep that from. It's a speculation. It usually, the higher the margin debt, generally the more leveraged and dangerous the market is. Margin debt just hit 1.008 trillion, the highest level in history. That's more leverage than at the peak of the dot-com bubble or the 2008 crash. It's the most dangerous signal in the markets right now. And remember what we were saying last week? Ma and Pa have virtually no exposure to commodities as the world's commodity exchanges are being bled dry month over month. The largest deliveries ever. 6 billion in the first 3 days of this month, 8 billion in May, the largest silver delivery ever in May, the largest gold delivery ever in May, and on. Every month we're seeing this, and the public has virtually none. On the other end, the insiders are dumping stocks at record levels. What's his name? From Jeff Bezos, 6 billion worth of stock since June he's sold.
While retail traders pile into stocks, corporate insiders are fleeing. Since June, Jeff Bezos sold over $6 billion in Amazon shares. Warren Buffett, Jamie Dimon, and Mark Zuckerberg have followed suit, with institutional sell-offs averaging $2 billion weekly. This isn't coincidence, it's strategy. Insiders see storm clouds gathering and are reallocating to safer assets, especially gold and commodities. The contrast is stark. The public is all in on equities while the elite cash out. It's a textbook setup seen before major downturns. History doesn't repeat, but it often rhymes, and the smart money seems to be hearing echoes from 2008.
Look at Jamie Dimon, look at Warren Buffett, look at Zuckerberg. They're all dumping. The institutionals, the big traders, have been averaging $2 billion a week since June of sales. They're all leaving the equity market, and you have the largest amount of margin debt ever and the largest allocation to stocks by the retail public in an all-time. What could possibly go wrong? The insiders are going heavy in commodities and dumping stocks, as the public has nothing in the way of commodities and is the deepest in not only the stocks, but also margin debt of all time. It's a very, very bad thing. And if you're a conspiratorialist or realize that the line between conspiracy and reality has grown thinner and thinner and thinner, or you just realize that the big money, like the little man rule, is always moving when the other group has no idea. And this is how it always goes. So should we expect, August is typically the worst month of the year for stocks. September is usually a bad one too. But should we expect something? Remember what happens in October. We're at the part of the year where it's typically very
choppy.
Tenuous. Yeah, choppy. So, but at the same time, the biggest money in the world is jumping into gold and silver, and no one knows it. No one understands it. No one sees it. It's a big deal, Dunnigan, and whether you're talking unemployment, inflation, everything is pointing towards craziness coming up. And to me, the real demand for physical metal on COMEX underscores everything, because that's never happened before. When you see every contract stopped, every single one that was posted went to delivery instead of settling in cash. I mean, these are things you never see, ever.
Commodities, especially physical gold and silver, are quietly being drained from global exchanges. In just the first 3 days of this month, $6 billion worth was delivered. In May, historic records were broken in both gold and silver deliveries. Why? Smart money is rotating into hard assets as financial uncertainty deepens. Meanwhile, the average investor holds almost no commodity exposure. Behind the scenes, even central banks are hoarding gold at record pace, signaling a pivot toward tangible stores of value. This exodus from paper wealth into physical commodities is being missed by the public, but it won't stay hidden forever.
And it's continuing. So I guess only time will tell where this all ends up. But even like our allies are pushing back. India is being threatened if they continue to buy oil from Russia with another tariff from Trump. Well, India said we're not going to stop buying oil from Russia. So, at what point does it piss off our allies so much we keep poking them? Where they say, you know what, I'm glad I've set up an infrastructure with these guys. And at what point does Saudi Arabia, who is a full member of the bridge technology and involved in all of these meetings and setting up a Shanghai Metals Exchange in their country, what point do they say, we're done? I mean, this is the little by little. Are they waiting out Trump? I don't know. But you can see this, and we're even aggravating Mexico and Canada and all of these countries that have been on our side. We're putting tariffs on all of the European countries that were supposedly our allies. Maybe they really are trying. I think they are trying to lose the reserve status. They understand it's hollowed out our manufacturing. There's no way back unless we stop being the reserve status, but focus on the legitimacy of our treasury market. That's more important. And I think it's a soft default on the dollar and the lesser of two evils. And everything I'm seeing, whether it be Trump's actions, the market's actions, the gold inflows, the central bank purchases, the repatriations, everything is pointing to this, everything. So yeah, it's, I think the worst possible place you can be right now is really, truly is a large dollar holding. And we haven't even talked for a while about the banks. We don't need to today, but keeping your money in a banking system where if things go haywire, you're an unsecured general creditor in a currency that's lost 11% this year, and just accelerating the trend that we've seen since forever, since the Fed came up, and since 71, we've lost 90%.
America's allies are growing wary. Nations like India continue importing Russian oil despite U.S. threats. Saudi Arabia is cozying up to BRICS and backing a Shanghai Metals Exchange. Even Mexico and Canada are showing signs of strain. Tariffs, sanctions, and financial bullying have fractured trust in the U.S.-led economic system. The global shift away from dollar dependence is accelerating. This isn't just geopolitics, it's a vote of no confidence in U.S. fiscal discipline. The dollar's reserve status, once untouchable, is under pressure. If this trust erodes fully, the consequences could be enormous for U.S. assets, debt markets, and global dominance.
I don't know. I just think it's time to realize that we're there. We are there right now. With this new stablecoin bill, you could argue it is a new monetary system that is happening, going from synthetic demand from organic demand to synthetic demand, and that's where it all starts. So loss of confidence, loss of trust, loss of value. Now's the time. And now I'm going to caveat this last piece. I know we're getting to the end here about David Rogers' Webb, The Great Taking. I think I'm right about this, so I'm not positive, but I'm about 95% certain about this. Okay, his whole premise is that you don't own this stuff and it can get taken from you because it gets pledged, your securities get pledged to other entities. And it has to do with margin, where every account you have is margined unless you specifically tell the brokerage, do not ever put me on margin. In other words, they can take your securities and lend them out to others on margin. And when that happens, if they get that margin call and default on it, those stocks that were margined out, which you didn't even know you lent out, they go to the company that leveraged or that lent them out. They have first right over you do. I mean, that's pretty much his whole thing. And I guarantee you 99% of the people who own stocks in this country have no idea that you have to physically and expressly tell the custodian or the brokerage, do not ever margin anything on mine. You have to fill out some paperwork. Otherwise, they are marginable, and that's how you lose them in that the system where it just collapses. So
That's where you end up where my wife and I were when they informed us that we weren't going to get access to our funds. And we said, no, we were in those low risk cash equivalent second day access. Yeah, that's not what was going on with your money on the backside. So even if you think, just like your money's not in the bank and your stocks aren't in the brokerage, they've all been loaned out on both.
So if you have an account, tell them never to put me on margin. That's the lesson of today, and I think I'm right on that.
Most investors don't realize that their stocks aren't really theirs. Unless you opt out, brokerages can lend out your shares on margin, pledging them to other entities. In a crisis, these rehypothecated assets can vanish. The disturbing theory known as the Great Taking suggests a systemic plan: shift ownership from the public to institutions through hidden leverage mechanisms. If a broker defaults, your stocks may be claimed by someone else. Even cash in banks is unsecured. It's not fear-mongering, it's legal fine print. Financial literacy isn't optional anymore. Knowing how margin accounts work could mean the difference between safety and ruin.
I don't think people want to do that. You have zero liquidity then. To get them back into the system to sell them would take you months, and it has to go and get reread. They make it purposely almost near impossible. He's right. To put it in your own name and hold the actual certificates, which no one does anymore, would make it safe. But try to sell it, it's going to take you forever to get it in through. There's an agent, I forgot what they're called, some form of agent that has to then issue it into the system. Again, it can take a month or longer. I wouldn't do it as much as he's right about it. You have zero liquidity, and that can kill you. By the time it gets in there, you're dead. This is how premiums work. I mean, we had a couple clients that bought a few $1 million worth of them, and when we go out to buy more, we sell them at a price that that you can't really find them for, and then we go out and try to buy more. You can't replace them. So those that are, it's kind of like it's kind of like Judy Shelton's idea of pegging gold to the Treasury. There's always going to be demand for the long end of the Treasury at a certain rate, but that certain rate can blow up the entire system if it goes too high. So it's the same thing here. I mean, that was kind of a stupid analogy, but I'm getting to the point where that. You'll always be able to find these coins if you're willing to pay a certain price. And to go out and buy a whole bunch more, the premium is already up about, what we say, about 50, 60 bucks, about right? 50 or 60 bucks an ounce, which made it really good deal for trading a bar or a coin for it. Now it's not as good of a deal, but it still makes it a hell of a deal in buying them in comparison to gold bullion coins.
Physical gold is increasingly difficult to source at fair premiums. As institutions rush in, premiums have jumped 50 to 60 per ounce in recent months. Some private buyers can't even replenish supply at the prices they sell for. Meanwhile, collectible and backdate gold coins, especially 2025 dated eagles, are gaining popularity, sometimes even trading at a discount compared to older coins. But holding physical metal, while safer, comes with trade-offs, low liquidity and slow resale processes. Still, in a world of growing distrust toward fiat, margin, and digital IOUs, owning tangible gold remains one of the last forms of pure financial sovereignty.
Especially 2025s. I want to say one other thing, and that is that with the exception of silver eagles, which you pretty much don't have much choice but to buy 2025s in larger quantities. So we do have some backdates. But, we're already starting to talk to our distributors like the UK about 2026s. And so to put stock in 2025s, which in 5 months will be backdates, the whole concept of new date coins is nuts. Most companies sell backdate for a higher price. We sell them for a lower price. You go on a lot of the online companies and look at a mint box of 2017 or 18 or 19 or 21 or 22. They're all higher. If you buy backdates from us, like a mint box of backdate coins or something, or anything, you're going to get them at a discount.